Okay, guys, hope you got a good break. Do what you need to do. This next section is valuation. I do want to let you know today is going to be a little bit lengthy in material and curriculum. Tomorrow will be a little bit shorter. I did send out that final itinerary on Thursday to you. So today, again, we'll go about 5 hours of curriculum. So pace yourself. That's why we'll have these breaks in between each section. And then tomorrow will be only about 3 hours of curriculum before we get into the question and answer session. So this is valuation. This will be about 20 minutes long with Mark and Mark, starting on page 26. So back to Mark.
Okay, everyone, welcome back. We're going to talk about valuation and super performance. What's high? What's low? What's a good valuation? What's a poor valuation? Does valuation even matter? We found that the valuation, when I talk about valuation, I'm usually talking about the PE ratio, or some use book value, and these metrics that are supposed to be a measure of whether a stock is undervalued or overvalued. Well, we have found, and like I said in the beginning, that the market leaders are going to seem like they're expensive, and this is what keeps most people from buying them. So what we found is, the bottom line is, we're generally ignoring the PE ratio to a certain extent. We're certainly aware of it, but a PE ratio really just tells you how popular or how much is being priced into the stock. And I'm just going to give you some examples. And again, this is purely perspective. We are not going to be showing you to say, if the PE ratio is this, you're going to buy the stock. And the PE ratio is really the least component of anything that I do or Mark does for trading stocks. However, we are aware of it, and you do need to understand the way that these cycles work and put everything into perspective, and you'll see why soon. So the first thing I want to show you is an example of Yahoo. Remember, I talked about how I was buying Yahoo when it was coming off of its first initial base back in 1997. You can see here that around that time, the PE was 938 times earnings. And back then, I was advising institutions. I had some of the biggest hedge funds in the world were my clients. And I was bringing to them these internet stocks that no one even, heard of, and very few people even believed in the internet. As a matter of fact, there's a clip on, I believe it's on YouTube now, of me on a show with Ron and Sana and CNBC. It's in, like, I think 1998. And Ron's question to me was, because I bought Yahoo and I had made a double on it, and on the previous show I recommended it, he had me back a couple months later. He said, do you think the internet's going to survive? So, like, can you even imagine, anybody asking that question nowadays? No one would ever think that, but that's where we were at the time. So Yahoo was trading at 938 times earnings. And when I would bring that to these institutions, they would say, Yahoo, what are you talking about? What is this company? And on top of it, who in their right mind would ever buy a stock trading at almost 1,000 times earnings? Well, a couple of years later, Yahoo was trading at 1,700 times earnings. And those same people who didn't want anything to do with it were clamoring to buy it, and everybody was buying Yahoo. So again, value in the stock market, usually what seems expensive is nearly expensive as it seems, and what seems cheap sometimes is not as cheap as it seems. And what we have found is that you have to be real careful about buying a stock on the basis of valuation. Now, there are some people who do this tremendously well. Someone like a Bill Miller, who is one of the best at value investing. We don't. I personally don't know anything about value investing. I don't know. How about you, Mark? Have you? Would you claim that you know anything about value investing? Because I certainly know very little.
Yeah, only enough to be dangerous. So no, I don't. I don't look at any of those metrics. PE, book value. It may as well be another language to me.
Right. And so the problem that you have to be careful of, if you get into any type, not just valuation on the PE, but any type of cheap analysis, quote unquote cheap. So the price is down, it's near its 52-week low, or it's down, it's oversold. Okay, stock is deeply oversold. Whatever your idea of cheap may be, you have to be very careful that you don't get caught in what I call the cheap trap. Because when you buy a stock based on it's cheap, well, what happens if it goes against you? If it goes down, if it's at 20 and you buy it because it's cheap and it goes to 18, it's cheaper. So based on the it's cheap theory, it's more attractive. And this is how a lot of people blow up. They'll just keep buying it. They'll say, well, I mean, my God, it's Facebook. You know, how low can it go? It's it's PayPal. It's whatever. Back in the day, it was IBM. There was other back in the 50s, 60s. It was Avon Products and Eastman Kodak and DEC. And so every cycle, every couple decades, it's the new name that can't go down, that everybody loves, and it's impervious to the downside. But very few people thought that the stocks that are down 60, 70, 80, 90% right now could ever go down that much. So the problem with the cheap theory is that, again, you get locked into a stock when it falls because it's cheaper, and people have a hard time using stop losses as it is. The one thing about a very high PE stock, when you're in the fast lane and you're trading these stocks that appear overvalued, is that they're priced to perfection. You know that they're priced for performance. So when they stop performing, I run like a deer, because I know there's big downside in any stock. But certainly, if the stock has a very high PE, well, there's high expectations. So with the cheap stocks, a lot of times you'll get to the lowest, and this is standard, analyst type of analysis regression, where they'll go back, they'll look at a quality company, and it's traded at a PE of between 20 and 30, and the growth rate is still pretty good, but now it's trading at 15 times earnings. It's half of its, historic PE, but still 50% of its growth rate. And now the PEG ratio and all these things. The thing that they ignore is that the stock is discounting the future. Just like it discounted it on the upside with the high PE, the low PE is discounting the future going forward. I'm going to show you some examples, but the question is, how low can these go? Well, you look at something like Skills, which SKLZ, which was one of the many that Kathy Wood was buying all the way down from the IPO. Something like a PATH, another one that these companies. Now, these may not be these big quality companies, if you will. It's certainly not IBM, but again, when you're in this area where you're trying to buy stocks that are down, and they got some great technology, they're a value, whatever you want to make the case for cheap. Well, here's a stock that is trading 40, 50 bucks a year or two ago. It's 90 cents now. And you can go back and you can look at PayPal. You can look at some of these really big stocks that are quality names, and they're down 60, 70, 80%. So how low can it go? Your risk is always 100%. It's always 100%. So, all right, well, your argument might be, well, that's a crappy company. I mean, a real good company could never do that and go down that much. No, go do your homework. Go back and take a look. Here's GE. Here's GE, similar, trading up $40, $50, right? Stock comes off about 8%. You had plenty of opportunity to cut your loss and get out. Gets below the 200-day moving average. Still had plenty of opportunity to get out a small loss. Down 50%, down 90%. Here's the thing. Take a look at the chart. Look at the PE ratio. Right here, it's the cheapest. It's the cheapest it's been in years. It just gets cheaper and cheaper and cheaper and cheaper. Meanwhile, once you're down 90%, you could be in the best quality company in the whole world. It's got to go up 900% for you to even get even. How many stocks do you buy that go up 900%?
Yeah, I'd just add too, Mark. I think, back to one of the very first slides where you talked about the goal being to compound returns. And the reason this type of strategy or buying cheap is so dangerous is it puts you in a position to do the exact opposite, compounding losses. And almost every blow up, that I'm aware of in terms of people blowing up their accounts or getting into big trouble, this is precisely how they do it. Because if you loved it at 20, you're going to love it more at 10. And at 2, and then that is exactly how you dig yourself in a hole that is really, really, really difficult to get out of.
Yes, and we're going to talk about a few components later on, time and price, but you're not only losing money, you're losing time. Now it's taking you all this time, and the more the stock comes off, the bigger the break, the more longer it's going to take to come back. So you're not just killing your capital, you're killing your time, you're killing your compounding ability. Well, let's look at some examples though. I want to show you some examples. These are all, and virtually all these stocks, I'm showing you not something like SKLZ. I wasn't in that. And GE, I certainly would never hold in a decline like that. But Crocs, I was in during this up move. And just before that made that big move, you had the highest PE that it ever traded at. Okay, just before it went up a 400% advance. And look at here, just before it went down 90%, you were at the lowest. It was at the lowest PE. You went and you broke the low, and that was on this big break. That was actually on an earnings report. And then from there, the stock went down 90%. And look at the valuation. Oh yeah, it's a great value all the way down, getting cheaper and cheaper and cheaper. Let's go back, take a look at Ollie's. This is one that I bought. As a matter of fact, David Ryan and I both were buying this around the same time. We bought some on the exact same day. I actually bought some, I think, a week earlier before him. I was adding to my position when we were buying it on the same day. I'm buying it. You can see just before it sets up this base, or during this base, it's trading at over 100 times earnings. I'm buying it around 100 times earnings. And now the stock goes up from there over 300% in 30 months. But look at the valuation of it. It goes down. It goes down, it gets lower and lower. So why is the stock getting a better valuation? It goes up 300%. And now it's a better value than when it was way down here, trading around 20, now up at 90, 95, 100. Mark, why? How could that happen?
Yeah, the market is a great discounting mechanism. The stock is growing into those future earnings that it was, projecting early on. This is one I also traded multiple times. And does a great example of a stock that is in its own earnings cycle, which is what this chart is showing you. It's continuing to make these bases as the fundamentals continue to be strong. And I think this stock, even, we'll get into that. This stock, I believe, rode the 50 or better for like a double or a triple coming out of this primary base.
Yeah, and so the earnings are growing faster than the stock. And so the stock is, as Mark said, is discounting, is moving up and is discounting. I got a little Facebook thing coming up here. Let's see here. Oh, here's another one I bought, Taser. Taser was a big winner for me, a double in a very short period of time. I'm buying Taser right here on this day, on January 12th, 2004. The stock had previously gone up 12-fold in 7 months, trading at 230 times earnings. Well, many people thought this was high. It looks high, right? It looks like it's in the stratospheres. But now when we go look at it here, here's where I'm buying. It was just the beginning of a almost 500% move in less than 2 years. Now, each time it comes out of these bases, you can see the valuation is getting lower. It's getting better and better, and still 150 times earnings. And then finally, it accelerates, and the valuation, it starts running up faster than the earnings. But the earnings were growing so fast that it kept knocking the valuation down. So the valuation, if the earnings are strong enough, the valuation will take care of itself, and the stock will discount that. And that's why, and we're going to talk about this later on, but this is the power of very large earnings, large numbers. This is why you preferably want to be in a market leader that's delivering very strong earnings, because when you have strong earnings, you can only discount out so far. The stock, the analyst, and the CEO himself, nobody knows how long a company can maintain 100% earnings or 50% earning growth per quarter. It's just too fast. There's no way of knowing how long that's going to go. So the stock is never fully discounting, or you're never going to have an efficient market. It might be at the current moment, but when those earnings keep coming out, the stock's going to move higher. I'll show you an example of that. So you take a look at Apollo, and again, this was during a time when you, like Mark just said about being in your own earnings cycle. We should probably explain that. When a stock is in its own earnings cycle, it's not being affected by the economy, other outside factors. This company's doing well regardless. It's not cyclical. It's in its own secular earnings trend, and that's why it can do well even in a very difficult market. Nasdaq had a terrible bear market and then continued down and only sideways over a number of years, very treacherous in the 2001 to 2003. and Apollo went up several 100%. Now, during that time, if you take a look, the stock price from mid 2001 into 2004 went up 200%, right? Well, here's the annual earnings each year. In 04, you were up 40%. 05, you were up 45. 04 up 45%, and then 55% in the next year. Well, the stock was discounting. If you take a look and you compound those earnings, they're 200% higher. So 3 years later, you've got 200% higher earnings. You have a 200% higher stock. Now, it doesn't mean that a stock's going to do this perfectly, and it's going to be up. If the earnings go up X, the stock's going to go up that much. However, but you can see that this is how you discount. You see the PE right here? It's unchanged. See, the valuation is the same. The stock goes up 200%, but the valuation is exactly where it was. That same high 60 times earnings. It's still 60 times earnings because of the earnings are coming in. And as long as they're delivering the earnings, the PE could be unchanged or even go down as the stock goes higher. Now, here's where you run into where the amateur and the mediocre analyst try to use this PE analysis, like I said before, where you'll look at the historic, and then when the stock's down, the PE's down, you start looking at it as a value. This is what you're going to hear many people are going to start talking about. Netflix, Amazon, Facebook, they're going to start looking and seeing that these stocks are down. How much lower can it go? It's already down 75%. Its PE was normally, 40 times earnings. Now it's selling at 15. Yeah, there's a good reason, because the growth is over. The growth is over. The stock is discounting. This is what I call the broken leader syndrome, where you'll go where people who weren't smart enough or didn't have the skill to identify a leader before it made its big move now think they're geniuses because they can open up the newspaper and look up the PE ratio and see that, oh, wow, it's trading at 15 times earnings now when it used to trade at 40. And this quality, great company, I could get it at a discount down 75%. No, that's what you want to stay away from. Right? And what happens, here's what happens. This is the important part of the chart. Right here, you see the stock comes off and the PE comes down. And it's looking like, okay, it's getting down to the lower end of its valuation. But all of a sudden, why does this happen? Look at this big, giant jump. Because now those bad earnings or those negative earnings that the stock was discounting, all of a sudden they show up because stocks discount. And now what appeared to be a value, all of a sudden, almost overnight, is massively overvalued. That's how it works in the real world. Okay, let me show you another example. Same thing with lumber liquidators, right? It's a leader here. PE's at the highest. It looks expensive. Stays that same expensive, whatever it is, 40, 50 times earnings through its entire move as it makes this big move from 30 bucks or so up to 120. Now the stock tops and breaks. Now you're at the lowest PE that it's been, right? And it's getting down to where it's at the low end. Well, it comes off more, it breaks again. Now it's down, 90%. Oh my God, what a value now. You're getting this company that's growing so strong, and now the PE's at the low end, and then all of a sudden, wham, the PE just explodes without the price moving. See, the price doesn't run up very much because the earnings now, those bad earnings, the losses start showing up. And what appeared to be a value is actually massively overvalued. You're way more overvalued here, down 90% than you are up here. How could that be? How could that be when the stock's down so much? That's why you can't have this bias where you're buying stocks just because they're down and just because it's Facebook or it's some quality company. It just doesn't work that way in the real life. All right, one more thing here. So what's the downside? It's always 100%. This number right here, I'm using 50. It could be 90. Stock goes down 50%. You buy it here. Goes down another 50%. Someone else buys it here. Goes down another 50%. Someone buys it here. Goes down another 50%. It could just keep cut. It could be 90. Goes down 90. You buy it at 10. Goes down to $1. Someone buys it there. It goes down to 10 cents. Someone buys it there. It goes down to a penny. The downside is always 100%. People think, well, the stock's down 90%. How much lower can it go? 100%. Okay. So Now, the reason why we're showing you this is because we want you to do just the opposite. Okay, remember what I said on that very important slide about the 95% club? There was the very first line there that said 99% of the stocks were above the 200-day moving average, and furthermore, 98, just about the same, were in what I call a stage 2 uptrend, which we're going to show you in just a second after we take a very short break. We want you to do the opposite of buying stocks that are broken in downtrend. We want you to buy stocks that are in uptrends. Why? Not just because that's what history tells us. The big winners are going to be in uptrends. And I'm going to explain that to you. And there's still lots more to go over. We have not even touched the very tip of the iceberg here. Okay. So if this has even been remotely enlightening, you have 99% more to go here. We're still in the perspective stage, right? We have not gotten to any tools, any tactics, any meat and potatoes, any real depth here yet. We are at that satellite view. Okay, we're going to come down to an overhead view pretty soon, and we'll keep moving down until we get to that very surgical, which will be in later days. We're going to take a quick break, and then we'll be back. And we're going to go back we're going to come back talking about the stock maturation cycle. All right. See you in just a minute.
All right, guys, that was valuation. We're going to take a break here again before we pick up on that stock maturation, just 5 minutes. I do also want to remind you to make sure you do have your first and last name registered. Calvert is really the only one I'm seeing right now. Calvert, I do need you to identify your last name or type into the chat box your last name for me, please. And otherwise, let's just take a quick 5-minute break. We'll be back.